Welcome to Lesson 10, Part A. We are going to talk about the portfolio beta. The beta is a risk metric, namely a systematic risk metric. Let's go for an intuitive definition of this metric. In these charts, we have the system under assessment on the y-axis and the market, let me say the US stock index, on the x-axis. The y-axis and the x-axis report the returns of these systems. Let's start from the illustrative system on the left. We see that when the market carries a loss, the system carries a loss too, and when the former carries a profit, the latter carries a profit too. That is an example of a system with a beta equal to 1, meaning high correlation to the market. Quite the opposite, on the right-hand chart, we schematize an illustrative system with a negligible beta. This system makes profits regardless of the market performance. Thus, it involves a negligible systematic risk. Let's see what a high correlated system looks like. A system with a beta close to 1, let's say 0.90. The plot of its returns over time is rather overlapped with that of the US stock index over time. That means high systematic risk, or, to put it from another perspective, poor value of the system under assessment, as it delivers nothing more than an ETF replicating the benchmark, which in turn comes at lower management cost. Here instead, we plot an illustrative system which has a negligible beta, let's say 0.10. The MASASP system combination is a system of this kind. Its plot over time is really distinguished from that of the US stock index. That is something which can't be attained with a cheap passive benchmark fund. Let's see what happens with our four-system combination. This combination is characterized by a very small beta, which is a good news to the investor. That is apparent from this chart, as the system is able to deliver considerable profits, even when the market carries losses. That is not only true as far as the annual time series is concerned, but also if we switch to the semi-annual time series. The dark blue bars represent the system returns, and the white bars represent the US stock index returns. Here we have a beta which is even smaller in absolute value than that from the previous slide. The beta calculated with respect to the monthly time series is on the same order of magnitude, 0.10. Drawing conclusions, the system and correlation to the market holds regardless of the time frame that we take into account. That's all for the time being. In the next video, we will focus on the risk-adjusted performance. Thanks for watching.